Hello, everyone. I'm Bob Goulder, a contributing editor with Tax Notes. Welcome to the latest episode of our ongoing series, In the Pages, where we take a closer look at some of the more popular pieces that have appeared in our recent publications. Our topic today is sort of a big picture issue. We're talking about how much profit shifting is going on among US-based multinationals. And when you think about it, this really was at the heart of the BEPS project that the OECD was coordinating a few years ago. And even today, it's still really at the heart of what's going on with their subsequent efforts in regard to the Pillar 1 and Pillar 2 reforms with the inclusive framework. Now, naturally, if you're going to talk about profit shifting and make claims about it, you don't want to rely on anecdotal statements. You want hard numbers, meaning you need a good data set. And fortunately for us, our featured guest today is someone who really knows her data sets. She is Kimberly Clausing, professor of economics at Reed College in Portland, Oregon. And in just a few weeks, she will be a professor of tax law and policy at UCLA. Professor, welcome back to the program.
Thank you so much for having me. It's a pleasure.
Now, let me just say that you've been writing, and brilliantly, but you've been writing about profit shifting for a long time. Okay, so this isn't something new. I guess what's unique here is that we have this BEPS project that seems to come out of nowhere, and when the dust settles, we have this strange, fantastic new thing called country-by-country reporting. Can you work us through what this is and how it works in the U.S. context?
Yeah, absolutely. I mean, one of the big achievements of the OECD BEPS process so far actually is the creation of this data set. They recognized right away that one of the difficulties with profit shifting is it's mysterious. Like, people don't know exactly how big it is. Some of the existing data sets aren't very good. And even if you rely on the sort of best practice data, and you're going to have sort of an incomplete picture. So what the OECD process has sort of suggested for a lot of countries is you should collect this country by country data. So far, 90 countries have implemented that, 50 more have indicated they plan to adopt. And the United States is one of the first to release the data on a complete basis. So we had an incomplete release in 2016, and then a complete release in 2017. And the United States has implemented this country by country data by requiring multinational companies of a certain size to submit a new IRS form, Form 8975. And on this form, they include all sorts of helpful information on a country by country basis of where they have their activities, things like assets and employment, but also where they're putting their income and where they're paying taxes. And so this is a really valuable data set. It tells us a lot more information than some of the other data sets did. It includes many more countries. So that's very helpful. We get about 140 economies in this data set, whereas the other ones had 40 to 50, maybe 60 at the most. We also can separate companies with profits from those with losses. And so it's got, a lot of subtleties that the prior data sets don't have. What we don't have yet, unfortunately, is a time series, right? Because it's new data. So we've got a look at 2017, but as time goes by, we'll get a time series as well, because each year they'll release more data and more countries will be releasing their own data.
So now the title of the article, I've got it right here, it was on the cover of our magazine, the 5 lessons about profit shifting from this data set. But before we get to the 5 lessons, though, in the preliminary material in your article, you mentioned that there's this potential for double counting. And as soon as somebody hears that, like, well, what's being double counted? Are domestic profits being double counted? Are foreign profits being double counted? If you adjust for it, are you lowballing the overall estimates of profit shifting? How does this issue come about?
Yeah, so double counting can happen if intercompany dividends are counted in multiple countries. And in fact, one of the common data sets used before has long been recognized to include some double counting in it. One of the difficulties with the prior data is very hard to correct for the double counting, and so you were sort of left with options of either kind of lowballing or highballing the data. In this case, the U.S. instructions provided by the IRS make it quite clear that you shouldn't be including intracompany dividends as part of revenue, and so that should really help with this problem. That also implies that you shouldn't be, if you're not including something in revenue, you shouldn't be including it in profit, although there's some confusion in some countries about how that line has been implemented. So the OECD recently took some steps to clarify this matter for future data years, so that should help, in the other countries. In my analysis of the US case, I exclude all the income that is somewhat confusingly referred to in the data set as stateless. So what they mean by stateless income is not what you and I as international tax experts mean when we refer to stateless income, and we could talk about that later. But they're often including some income that might include pass-through flows and other things, and it's not really clear what that line of the data shows. So what I do in this analysis is I just exclude it. I focus on the other things that we're much clearer on, and if you focus on those other lines of income, it looks like there's a very similar total amount of income in this data set as there are in others. Now, there's a small discrepancy between these totals and some from some of the financial databases, but there are multiple reasons for that, including this data set includes a lot of private firms that might not be picked up in that country, in the financial databases. But if you compare the share of US income and those totals from those financial databases to this, you actually see a somewhat higher share of US income in this database. So if there is some overstating, we think it's probably of the US income rather than the foreign. But in general, it looks like the totals in this data set are quite similar to others, other data sets that we know don't include double counting. So I think the chance of there being significant double counting in this particular US data is quite small. One final issue is the use of the data. The data are intended to be used for transfer pricing risk assessment, and that's quite clear to the companies who fill out these forms. So I think for that reason, it would be odd if they were overstating the income in tax havens when they know the data are going to be used in part for transfer pricing risk assessment.
Yeah, they'd have no natural incentive to do that. If I'm Corporation X and I'm filling this thing out and I'm the tax director, I have no incentive to say, hey, let's push a little bit more dollars into that one column because we want to make it look like the money's going. Yeah, there's no incentive to do that. Okay, with that preliminary discussion out of the way, let's get to why we're here, what people are really, why they've tuned in, the 5 lessons. So we'd have our drum roll if we had a drum roll to insert here, but let's get to lesson 1. Okay, and this has to do with the role of tax havens. And I thought what was in the data was just astonishing. I mean, U.S. firms, we do business with companies all over the world, right? But our major trading partners, I mean, they're not all there. There's a list, you have figure 1 in your article with the top 20 countries where the profits are going. And I'm expecting to see, like all the G7. And I think Germany comes in like in 20th place. So what's going on here? What can you say about the role of tax havens?
Yeah, so that figure 1 in the article is really quite illustrative of the problem that the OECD BEPS process is meant to tackle, because it's quite perplexing in a way how much revenue is in these havens and how much profit is showing up there relative to these big economies, places like China and India and Germany and Japan, which really should, in theory, be the ones where all the activity is occurring. So if you look at those havens in that figure 1, of the top 20 countries, 11 of them are sort of havens with very low tax rates, and they together account for about 56% of the profits that year. If you look at accumulated earnings, which is sort of a stock of prior profits, it's 71% of the total accumulated earnings. So they really have a very dominant role in this space. And those countries are unusual. If you look at them, they are not big economies. They have very small populations. They have very small GDP, so you get these sort of absurd outcomes where, Bermuda's profits that they're hosting for US multinationals are much larger than their total GDP.
By many times.
Yeah,
I mean, it's
order of magnitude.
Yes. It's ridiculous. I think for was it the Caymans? The profits in the Caymans are 10 times the entire country's GDP.
Yeah.
So
implausible.
Okay.
Clearly, yeah.
All right, now it's okay to name names. The tax notes doesn't pull any punches. Are these the usual suspects? I mean, I'm going down the list here. Caymans, Singapore, Switzerland, Netherlands, Puerto Rico. Oh, U.S. territory. Okay. Bermuda, Luxembourg, Hong Kong, Jersey, Isle of Man, and so forth. Let me ask you this: Ireland. How do you treat Ireland? Because it's sort of on the fringe of being a tax haven, right? I mean, they do have corporate taxes. It's not the Caymans, but then again, it's not France.
Yeah, so Ireland is a really tricky one because I was using just a 10% effective tax rate cutoff for a lot of the analysis. And for the estimates of profit shifting that come later in the paper, it always uses that 10% cutoff. But in some of the diagrams, I nonetheless, and Ireland is just over that, just not under the 10% cutoff, but just over that. So Ireland doesn't really look as much like a haven as many of the other countries in the data set, but it is historically an important haven. And it depends on the year in the data set. You can find single digit tax rates, certainly for some companies in some years and some data sets for Ireland. So what I do in the paper is I show Ireland as part of the havens in some of the calculations, but not in all of them. And by the time we get to the profit shifting estimates, I'm not treating Ireland as a haven anymore by that.
And we have EU member states here. I mean, Luxembourg is there, the Netherlands, these are prominent EU member states. And so Netherlands is a tax haven.
Yeah, so when you look at these data, I mean, it really does point out that what a haven is in many cases an independent European jurisdiction. So we've got Switzerland, Ireland, Luxembourg, and Netherlands as four really dominant havens in historical data sources. And then there are some other havens like Jersey, Bermuda, the Caymans that are affiliated with the UK, and historically or at present, Puerto Rico, which is affiliated with the United States, right? And then we've got Singapore, right? So these havens aren't, one thing to point out is these havens aren't poor countries. These havens, if you look at their GDP per capita, it's often well in excess of typical countries. Aside from Puerto Rico, which has the lowest of all of those that I've listed, they all tend to have, over $50,000 GDP per capita, which is, so they're not poor countries just trying to scrape by with a low tax rate. These are some pretty affluent jurisdictions.
Mm-hmm. So how do the so-called BRIC nations come out in your list? Because China is there, India is there. I don't think Brazil was, but I mean, there's so much investment. I was just surprised that India and China weren't like in the top three.
Yeah,
and they were nowhere close to being in the top three.
Yeah, I mean, one of the really interesting things with this data set is there are places where you put profit and there are places where you do things, and those aren't usually the same places. So China, for instance, shows about $20,000 worth of profit per worker, which sounds, decent. And India shows about 8,000, but the world average is 50,000, right? So for China and India's operations look like they wouldn't be profitable, even though we know those are markets that it's really profitable to be in, right? Similarly, Germany, and other countries don't show a lot of profit per worker. But the havens, when you start to look at how much profit there is per worker, like in Bermuda, it's $60 million worth of profit for every worker. In Switzerland, it's 600,000, right? Both of those numbers are much higher than these. So it really does illustrate the sort of dichotomy between where companies are choosing to pay taxes and show their profits and the places where they're really doing stuff.
Yeah. All right, so time for lesson 2, and it's kind of a related point to what we were just talking about, but there is a misalignment between profits and economic activity. I mean, in my purest little world, I want the profits to be where the factory is. So if you have a low tax jurisdiction, I mean, if all the jobs are going to Mexico, then all the profits should go to Mexico. But that's not how the world works. And if anybody ever thought that was how the world works, they just need to read your article. So illuminate us on lesson 2.
Yeah. So lesson 2 is that there is this big divide between where the activity is and where the profits are. And I think that divide is troubling in a way that really did cause the BEPS process to come forward. It's the case, absolutely, that the big economies are where you want to do things. But they're not necessarily fun places to pay taxes when you can get down to a single digit tax rate. Now, one of the interesting things about these data is that even among the havens, there's sort of 2 types, right? So there's one set of havens that tend to be quite small jurisdictions like the Caymans and Bermuda, where you've got, multiple orders of magnitude, like 100 to 1,000 times the normal profits per worker in those places. So as an example, Bermuda, $59 million profit per worker, whereas the normal would be 1,000 times smaller than that. But there are also some havens where there is a substantial economic presence. And Ireland is a nice example if we want to think of them as a haven, or Singapore is a good example too, or Switzerland, right? And in the Swiss case, right, $600,000 of profit per worker is a lot, but it's less than 60 million, right? It's, by, a couple orders of magnitude. It's still an order of magnitude higher than the normal, right? So you also have some of these jurisdictions where stuff happens. There are workers, things are occurring in Switzerland, so it's not completely a paper headquarters place, but still it's much more profitable to have the profits show up there than say in Germany. So if you've got an affiliate in each jurisdiction, you'd much rather show the profit in Switzerland than in Germany. And I think the reason that the BEPS process sought to tackle this is it doesn't really seem, in a way, healthy for a tax system to make the corporate tax itself somewhat optional, right? The idea that you can sort of move the profit and you can move capital income, is eroding that part of the tax base. And it's changing what we're doing as a tax system relative to what we say we're doing. Like the United States says that we tax 21%, and we used to say we tax 35% of corporate profits. But in reality, since we provide a lot of loopholes that let people shift money offshore, we're not really doing what we say we're doing, right? Whereas for a worker, for you or me, or some of these workers that are earning far less than you and I, it's not like we have the alternative of saying, okay, well, it's true, I earned the money as a nurse in this hospital, but I'm going to declare the profit in the Caymans, right? So it also shows the sort of inequities of our system, where the profits that accrue to shareholders can easily avoid tax by moving offshore, but the hard earned labor wages, don't have that alternative. And so it does sort of turbocharge some of the inequalities that we see more generally. And that's troubling, because we'd like the tax system to counter some of those inequalities rather than turbocharge them.
Yeah, absolutely. When I was thinking about lesson 2 in rereading your piece, I thought, well, what is the outward boundary on any company doing this? I mean, why not just shift all their profit? Why have any profits at all in a high tax jurisdiction? If this is completely discretionary, if I can report the profits wherever I want, why isn't 100% of it there?
Yeah, I mean, that's a good question. And I think in some companies' cases, they get sort of dangerously close to that ideal. So I think some of it could be, it's odd for an economist to appeal to culture, but I think corporate cultures differ in terms of how aggressive they are in shifting the profits offshore, but also in terms of, how sophisticated their tax team is, how truly multinational their enterprise is, whether they were able to take advantage of cost sharing agreements on intellectual property and other types of arrangements that might have allowed them in a foresighted way to make a good legal case for having the income offshore. And having the income offshore legally, is not the same as, having it truly earned there, right? You can come up with many perfectly legal ways to move the income offshore. And so to that extent, we might blame less the companies and more the policymakers that have sort of allowed these loopholes in our tax system, right? Because there is this discrepancy between, what the tax system is supposedly doing and what we're sort of letting it do when we look the other way.
Yeah, it does come across as a very permissive system. And that just comes across in the data. There's no way about it. Now, lesson number 3, and you mentioned this briefly before. The country by country reporting data is split up between profitable companies and loss companies. And so different batches of data, you can have different analysis, different conclusions, different average rates and so forth, different footprints in terms of where the profits are showing up. Now, when I first heard that, I'm just thinking, okay, if you're a loss company, I'm guessing you don't have as much money as much profit in tax havens because you're a loss company. So that's like an oversimplified way of my voicing my expectations as to what you're going to find. What did you find in terms of the difference systematically here between profit companies and loss companies?
Yeah, I mean, one of the really interesting things with these data sets is typically the data sets that are aggregated that are most useful for looking at this profit shifting problem, because you can really see a lot of the income. They lump together companies with profits and companies with losses into one big data set, right? There's a second set of data that just look company by company, but the problem with those company by company data sources, they often don't even show the income in haven. So if you look at Apple in the financial reporting, 50 billion of the income is missing, right? So you can't really see it all. But in the aggregate data, you should have that income. But if you combine the companies with profits and those with losses, you run the risk of getting the wrong effective tax rate, right? So we think that companies with profits are the ones paying the taxes, right? We don't tend to tax companies earning losses because it's a profits tax, right? But if we've got both loss-making companies and profit-making companies in the denominator, and just the taxes paid by the profit companies in the numerator, we're going to have too high a tax rate effectively. So if you look at, for instance, the German data, the effective tax rate looks extraordinarily high. It's well over 50%. And that's because there's some loss companies that make that denominator of the income earned look too small, right? So since the taxes are only paid by the profit earning companies, but everybody's in the denominator, right? You get the wrong effective tax rate. So what I suggest doing here is sort of using the positive profit sample, where we're just looking at companies with positive profits to calculate the effective tax rate. Because if we're thinking about what taxes are you paying on your profits, then that answers that question. But that might not be the ideal tax base, right? Because we might think, well, some companies might earn profits in some years and losses in other years. And so it's true that losses do reduce the tax base. So when we're thinking about like how much profit is there out there in the world to be taxed, there's an argument for using the overall one that mixes the losses and the profits together, because we know that losses will be earned, in some years. That should provide a lower bound, right? Because if some companies are always earning losses and some are always earning profits, right, then the profit sample would be enough. You could just look at that. But if companies toggle between, then you want the other. So I think in terms of the tax base, you can use the two data series as lower and upper bounds. But in terms of the effective tax rate, you should really be looking at the logical thing, which is the companies earning the profits.
Yeah, all of that makes a lot of sense. All right, now maybe the most disturbing of all the 5 lessons here is number 4, where we have the opportunity to gauge some of the losses, both in terms of the profits not captured by the U.S. tax system and the actual revenue losses that come from that. Just for example, you write that roughly speaking, about 2/3 of the multinational activities occur in the U.S. So if you take that as a sort of benchmark, you could sort of theoretically ascribe that, well, you'd want to see ideally maybe 2/3 of the resulting profits be reported there. But I mean, it's nothing like that. So do you get to the point where you can actually do some number crunching here? And in my case, it would be on the back of an envelope, but you're more sophisticated in your methodologies than that. What do you have in terms of ballpark estimates with both like the high end and the low end? There's a range here, but like how much revenue is the IRS missing out on?
Yeah, so I use several different techniques, and my latest sort of research in this area also uses several different data sources, right? So we can use this data source that I'm analyzing in this paper, but we can also compare it to what we would get from other data sources. And I think it's also important to try different stabs at estimating this. So one stab is to just do the back of the envelope calculation and say, okay, for all these havens that really do have these rock bottom tax rates, so let's exclude Ireland for now, but just focus on the ones with the really low, below 10% tax rate. If we think that some fraction of that income shouldn't be there, right, but it's just there artificially in places like the Caymans and the Bermuda, we could say, okay, well, maybe 90% of it is there artificially. So we take that 90% and we just assign it relative to the where the activities are to other countries, right? In which case the US would get 2/3 of that 90%. And that would be our estimate of how much the tax base we're losing to havens, right? And a more sophisticated way than that, I mean, but that's a starting point. A more sophisticated way would be to say, okay, well, what if every multinational reported the same profits per worker, right? So every country, every jurisdiction shows the world average profits per worker, then where would profits be located? And then so you can also use that to do a sort of a counterfactual of where profits would be. And then I also take an approach where I use basically a regression analysis to estimate how much tax bases respond to tax rate differences, right? And by removing that response, right, and saying, okay, well, the tax base is about this sensitive. What if it weren't? Then you can also get counterfactual sources of where profits should be. And regardless of which method you use and which data set even that you use, there is this sort of underlying finding that this is a very, very large problem, right? So for 2017, at 2017 tax rates, my best guess is that to look at all the multinational shifting, not just U.S. but foreign, that it's probably in the neighborhood of $100 billion or more in lost revenue. So that's a lot of money. Now, some of this is better estimated than others. So what I do for the foreign multinationals, since I don't have a good look at them, is I just sort of look at the scale of their activity relative to U.S. multinational activity, and I scale up the U.S. numbers. So if we were just looking at the U.S. multinationals, that might be more like 60 or 70 billion of the 100. But because there are also these foreign multinationals that are probably shifting profits too, we want to account for that and scale up a bit for that. And so those are my best guesses. And readers can look at the paper and see the different methodologies and data sets. And I've got a sort of a companion paper that's coming out in the National Tax Journal that also looks at even more data sets. But one thing that's quite clear is this very large problem. We may not be able to exactly precisely come up with the perfect estimate because there are a lot of uncertainties with respect to different data sources and methods, but every single estimate indicates that it's very big.
Mm-hmm. And it's good that you mentioned foreign-based multinationals, because it's not just a case of, like, to take some stereotypical examples, it's not just Ford and GM, say, and I don't even know if car companies have profits anymore, but assuming that they do, there are examples of US-based multinationals. You also have companies like Volkswagen, BMW, Toyota. They're foreign-based companies, but they're very active here in the United States. They can be stripping money out of the US tax space too. So it's not just the US headquartered multinationals.
Yeah, and to some extent, our laws actually make it slightly easier if you're a foreign-based multinational to shift income out of the United States. So if we take that into account, now it is true the U.S. culture tax may be a little more tax aggressive than some of the other cultures, and so we might think that would push in the other direction. So we don't know exactly how responsive the foreign multinationals are relative to the U.S. multinationals, but there's certainly not zero profit shifting by them, right? So we want to ascribe something to them as well. And the industries where we tend to see the most of this are tech and pharma, more than the auto companies, although I'm sure every multinational has an incentive to do this, but tech and pharma are often pointed out as industries that have a lot of this profit shifting activity.
Well, they both have IP. As soon as I hear tech and pharma, the first thing I'm thinking is intellectual property. So
yeah, and that makes the profit shifting a little easier. Although, as the late Ed Kleinbard pointed out, even Starbucks has managed to do this, right? Because the Starbucks experience is IP, right?
Exactly.
So it's a little more easy to port this across companies than one might think.
Yep. Okay. Well, now that brings us to lesson 5. And here's how I want to frame lesson 5. Somewhere out there, of all the people listening to this webinar here, there's somebody who's going to say, Professor, we fixed it. The problem's over and done with. We passed TCJA in December 2017, and look at everything that's changed. We've got a new rate. It's not 35%, it's 21%. We no longer have a nominal worldwide regime. We have a nominal quasi-territorial regime, but at least there is a participation exemption, and we eliminated deferral. All these things have changed, and they're going to point to guilty. They're going to point to guilty in the beat and say, we fixed it. So lesson 5 is policy intervention recommendations. These are your recommendations. You have 3 fantastic ways to fix guilty, but I'll let you take it. Tell us about lesson 5.
Yeah, so the Tax Cuts and Jobs Act, as people colloquially refer to it, didn't really fix this problem for a host of reasons. One is the rate decrease from 35 to 21 really didn't matter because all the shifting was going to these really, really low tax rates. So if you can pay 5%, that's better than 21, just as much as it's better than 35, right? And you've already got the accounting and legal expertise set up for that. So then the question is, do these other provisions cut down on it, the GILTI and the BEAT? And if we look at the data so far, and there is a different data source, not this one, but the foreign direct investment statistics that do show us where the income earnings are located for U.S. multinationals. And we see a very flat share of income in havens, both pre and post that legislation. So we have 2 years of data after the legislation, and the 5 years before have almost identical haven shares. So if GILTI is having an impact, it hasn't hit yet. So why not? Well, if we look at GILTI, what it does is it allows companies to take the global average of their income offshore, only the part of it that exceeds a 10% return on assets. And if that income is undertaxed, then a US minimum tax hits, right? So that's the basic structure. So there's a couple things that keep the revenue on that low. One, the rate is low. You get a 50% deduction for your GILTI income. So that's kind of cutting the rate in about half, though there's some subtleties about foreign tax credits that affect exactly what that is. It's global, so you get to average across countries. And what that does is sort of, I call it an America Last tax policy, because effectively, if you get it in the haven, let's say it's a 0% tax rate country like Bermuda, then you're only going to pay it 10.5%. But if you get it in Germany or Japan or a high tax rate foreign country, whatever you paid to Germany or Japan, that's going to generate some tax credits that you can use to offset the tax that would have been due on the Bermuda income. So basically, your first choice is a haven. Your second choice is a foreign country that'll generate tax credits to offset the haven tax that would have been due. And only your third choice would be the United States, right? Because you don't get special foreign tax credits that can offset this GILTI tax. So I think the combination of that global averaging, the lower rate, and the fact that you're exempting the first 10% return on assets, those three all make this a really kind of a flimsy minimum tax. So what I suggest is instead moving to a per country version of the tax, which means that every time you earn $1 in Bermuda, you pay US tax immediately on that, regardless of what's going on in your other foreign countries, right? And that's going to be a much tougher way to cut down on profit shifting to Bermuda, because now you can't just sort of offset the tax that would have been due with things that are going on in other countries. And it might encourage Bermuda to raise their rate, because if they don't tax the income, the US is going to tax it, right? So
yeah, it's going to be taxed anyways. They may as well.
Right, and that changes the entire dynamic of tax competition, because when all the countries realize that, if they're not going to tax the income the United States is, and if they then raise their rate, right, then that sort of props up not just the US tax base, but the German tax base and the Japanese tax base. And if they also pursue similar minimum taxes, they're propping up our tax base from the possible profit shifting of Volkswagen and Toyota, right? So it's kind of there's a strong case, I think, for a coordinated per country minimum tax, because it would sort of reduce this race to the bottom in tax rates and give countries reason to raise rather than lower other corporate taxes. I think that would be a useful step forward.
Yeah, what you just described, how close is that to Pillar 2 in the inclusive framework?
Yeah, the Pillar 2, I think has some of the same ideas at heart. I don't know how carefully you've looked at it. It's very complicated. And, it's unclear how generous it's going to be to the companies, right? So there's talk of carving out certain types of companies and certain returns and, and administering it this or that way. And so at the end of the day, it's unclear how strong that will be. I mean, I think you could build on that and do something actually a lot simpler. It was basically like all multinationals are included. There's a per country administration. There isn't a very big return on asset exemption. If you want to have a little one, that's fine, but there's no reason for it to be 10%, right? And we're all going to commit to having it be at least, say, 20% or something, right? I mean, if you imagine if countries did that tougher version of that, it could be quite effective. I think what actually emerges from that process is unclear yet how tough that will be. And it does look complicated in a way that makes me worry a little bit about maybe that introducing its own, workarounds in the process.
Yeah. But what you're describing could be a whole lot simpler than pillar two. You to paraphrase you, a coordinated global minimum tax. Full stop.
Yes, absolutely.
Yeah.
And I've got a paper with Emmanuel Saez and Gabriel Zuckman where we sort of describe what that would look like. People can find on SSRN if they want to read a little bit more about that. But it's basically an argument for coordinated minimum taxation. And I do think that there's an argument for actually making some of our global agreements kind of more focused on the needs of citizens. We've had an awful lot of trade agreements that are really catered towards what corporations want. And I'm a big free trader. I've written a whole book on that. But I also think it's important to have global agreements that address problems like climate change and tax competition that are really important collective action problems. And having the ability to raise revenue for the state in a way that's progressive means that you have to be able to tax capital income, and that means taxing multinationals.
Well, Professor, we have now gone over the 5 lessons. They've been illuminating, but I cannot let you go because there's one more thing we have to touch on. I would be remiss if I did not include in our discussion of country-by-country reporting the issue of transparency. You're not actually looking at the IRS forms, are you? The
No.
forms you meant? No, you don't see them. You're looking at what? A one-time, once-a-year aggregated compendium of all the U.S. data. What about just looking at the actual form and making it transparent?
Yeah, I think that's a great idea. Companies will argue that it's a violation of their confidential information, but you have to stop and wonder, like, if it's really such an important company secret to you that you put all the money in Bermuda, like maybe that itself is a problem, right? For one thing, I don't know that other companies couldn't figure out to put money in Bermuda on their own without seeing that you do it. I think what they're really worried about is the reputational hit, and I think I'd be happy to give them some warning and say, okay, these should be public in 3 years. And so you've got some time to rearrange things if you don't want to tell everybody that the profit is in Bermuda. But I think these reputational effects are actually an important market-based nudge to sort of encourage companies to think about the larger stakeholders in their communities and not just always the after-tax bottom line, right? So they want to attract investors, they want to attract workers, they want to attract customers, right? And customers and investors and workers, if they could see in a coherent and simplified form, and I'm not saying release a bunch of complicated things, just like something very similar to table 1 of what the IRS releases in aggregate form, just where your assets, employment, profits, and taxes by country, right? And then, then everyone would be able to see that. And I think by shining a light on that, we could actually motivate policymakers to handle better some of these loopholes that they've created, because they'll realize, oh, yeah, here's a company in my district that has, thousands of jobs in my state, but that all the profits are, on an offshore island, right? That's going to kind of put some fire in the efforts to sort of clamp down on some of these loopholes. And I think that would be, quite helpful for democracy, for our tax system to better reflect what it's actually doing.
Well, to me, those seem like very persuasive arguments. We are talking about public corporations here. If you're a listed company, you're a public corporation, you're subjected to, SEC regulation and so forth, and you want to raise money from the public and having people on Wall Street buy your shares. There's a give and a take to that. This could be part of that exchange, that social compact, if you will.
Yeah.
Maybe you could have a different rule for private corporations. What would you think about that? Would it make sense to have disclosed country by country reporting for public corporations that are listed, and maybe have a different rule for non-listed companies?
Yeah, I would make the benchmark one of size rather than whether you're listed or not. I mean, if you think about a large private company, it also benefits from all of the public goods and services of the U.S. economy, from our workforce, from our infrastructure, from our rule of law, right? And so I would sort of use a size cutoff. And if you're big enough, if you've got more than 850 million, and or use the country by country cutoff, right? Then you can tell that to everybody. And I would be fine with making that a private thing too. They're also protected by the laws of the United States.
Mm-hmm. So there is a way to configure these not as part of the tax return, right? There's the corporate tax return, and then there's a country by country reporting. So there's a section out there, 6103, about, you know, the confidentiality and so forth. I kind of like the idea of taxpayer confidentiality as applied to individuals and so forth. And this is not taking their tax return and putting it on the front page of tax notes. I mean, this would be a distinct filing with the government other than the tax return itself.
Yes, absolutely. Yeah, and I would support it in that fashion. Yeah, I don't think the whole tax return is actually that useful to the public anyway, because they may not have the expertise to understand it.
Yeah.
Yeah.
Do you think trade secrets would be revealed? Would we know, you know, the secret formula to Starbucks coffee or the McDonald's Big Mac, the special sauce? Are we gonna figure out trade secrets?
I mean,
Google's algorithm? What are we gonna know?
if tax avoidance itself is a trade secret, that itself is a problem, right? Like, so if their trade secret is they managed to get all the income into Bermuda, then by all means, let's know that.
That is the secret.
Yeah, and
but
then
it shouldn't be.
Yeah, and it shouldn't be, right? Exactly. And so, fine, give them a year to straighten things out before you make it public. If they really don't want that revealed, then they can change their arrangements.
All right. And yeah, quick last question. When do you think we're going to get information for the post TCJA years? I mean, it's going to be coming through the pipeline pretty soon now. We've got the results for 2016 and 2017, 2017 being the only complete year. We're getting close to the point that maybe not just around the corner, but at some point we'll be able to see if TCJA is doing anything.
Yeah, so the last two releases were at the very end of the year, right? So we got information in December 2019 that was the 2017. So if they, and I haven't asked the IRS, so I don't know what their plan is, but assuming they're on schedule, then that would imply that, you know, in the next month or so, we should get the 2018 data, and about a year from now, we should get the 2019 data.
All right. Well, maybe we can do another piece like this, and you can write another article about 5 more lessons once we look at the post-TCJA data. Professor, thank you so much for joining us. Thank you for writing the piece. It was excellent reading. If you haven't read it, listeners, look it up in the Tax Notes archive. You won't be sorry. And anything else? Final thoughts?
No, I think you've done a great job. Thanks for having me.
I think that covers it all. Thank you very much. Until next time, thanks, everyone.